2026 has kicked off with massive action in the silver and gold markets. And this is not business as usual. Silver saw record highs followed by one of the largest single-day plunges in history, which has traders and investors everywhere on high alert. At the same time, gold continues to act as a safe haven asset, steadily rising amid global uncertainty and market volatility, drawing attention from both retail and institutional investors. Precious metals have entered a new phase in 2026, a phase that could redefine key price levels for years ahead. This video breaks down the major moves happening right now. We'll unpack why the 2026 silver squeeze narrative is dominating forums, how gold's market update affects trading strategies, and where analysts see these metals heading by year-end. This isn't hype. These are real price shifts backed by data and market reactions around the world. Silver volatility and gold's safe haven status are drawing unprecedented interest. Gold's role in portfolios has never been clearer. During macro stress, investors flock to it for protection and diversification. And while silver began 2026 with explosive gains, it's now showing just how fast a metals rally can reverse when sentiment and technical conditions shift. We will explain what caused these twists and what they mean for anyone holding or watching precious metals. This silver squeeze alert and gold market update could be critical for your investing decisions. By the end of this script, you will understand not just the what, but the why behind these extreme market swings. You will get clearer insights into price levels, supply pressures, and investor behavior shaping the precious metals forecast. Let's dive into the core of this silver squeeze and the evolving gold price outlook in 2026. Right now, in 2026, the silver market is moving faster than most analysts expected. Earlier this year, silver reached near-record levels before dropping dramatically, a sharp reversal that demonstrates extreme market volatility and rapid shifts in investor sentiment. Retail traders, in particular, continued to buy even as prices plunged, pouring hundreds of millions into silver ETFs in just a few days. Gold, on the other hand, has been more stable but still dynamic, edging higher as investors seek refuge from geopolitical stress and macro uncertainty. Gold extended gains recently as the dollar softened and traders priced in potential rate cuts. These movements reflect fundamental forces, from currency shifts to shifts in risk appetite, that are reshaping precious metals worldwide. The current landscape shows investors reacting in real time to inflation data, Fed policy signals, and global risk events. Silver's moves are larger and more dramatic, while gold's trend is more measured but clearly upward. This difference highlights silver's status as a higher beta metal, where demand from industrial uses and speculative positioning can intensify price swings. So what's really happening now? Silver's volatility is signaling a structural tension between physical scarcity and paper market positions. Gold's gains show safe haven demand remains strong in 2026. These contrasting dynamics set the stage for deeper analysis on supply, demand, and forecast trends in the rest of this script. The silver squeeze refers to the idea that available physical silver is tightening quickly as demand outstrips supply on major exchanges and in the real world. This squeeze narrative has gained traction in 2026 because physical inventories have been moving lower while speculative interest and industrial demand remain strong. In other words, silver's paper market and physical market are diverging. This divergence means more traders are trying to hold or take delivery of physical silver than there is metal readily available on exchange floors, like COMEX. Some data show registered inventories falling sharply, which can add pressure to price discovery mechanisms and cause dramatic volatility. This is a core part of the 2026 silver squeeze story. At the same time, industrial demand, especially from solar, electronics, and electric vehicle sectors, continues to grow. Silver's role as both an investment and industrial metal makes its market behavior more complex than gold's. Therefore, supply limitations have a real effect on price momentum and speculative positioning. In simple terms, a squeeze means prices can move fast and unpredictably when demand suddenly outweighs what's available. Silver's structural deficits and rising demand in 2026 keep this squeeze narrative alive. Understanding this helps explain why silver's price action is so extreme compared to gold's. The key reasons silver and gold markets behave this way in 2026 are supply constraints, demand dynamics, and macroeconomic pressure. Silver's rapid moves were sparked by a growing gap between physical availability and investment demand. With inventories on major exchanges shrinking, price swings become exaggerated when speculative traders enter or exit positions. Industrial demand has also been rising steadily. Silver is used in technology, solar power, and electric vehicles, sectors that continue expanding even in 2026. This industrial pull adds a structural demand layer that differs from gold's primary role as a safe haven. Gold's rise stems largely from investor flight to safety amid global uncertainty, central bank buying, geopolitical tensions, and expectations of potential interest rate cuts have buoyed gold prices. Forecasts now see gold potentially reaching significantly higher levels by the end of 2026. Finally, macroeconomic signals like inflation data, currency shifts, and fiscal pressures worldwide heighten precious metals demand. These forces don't just impact gold, they also amplify silver's volatility because of silver's dual investment and industrial nature. This combination is a major driver of the 2026 silver squeeze and gold market update. The silver market in 2026 is being driven by multiple forces. Physical shortages are a primary factor. Inventories on major exchanges, like COMEX, are falling to historically low levels. This scarcity creates tension between supply and demand, fueling extreme price swings and rapid volatility. Analysts emphasize that silver's dual role as an investment and industrial metal makes these dynamics more pronounced than gold's relatively stable trends. Industrial demand remains robust. Solar panel production, electric vehicles, and electronics continue to consume significant silver, creating steady pressure on supplies. Unlike gold, which is primarily an investment vehicle, silver's industrial consumption introduces recurring structural demand, supporting a bullish market outlook in 2026. Investors and traders are closely watching these industrial signals to anticipate price spikes and potential squeezes. Speculation and retail trading also play a major role. As news spreads about silver shortages, retail investors enter the market en masse, further pushing prices. Short positions in paper silver contracts are increasingly risky, as physical delivery pressures can create rapid upward spikes, a hallmark of a squeeze. These market behaviors make silver one of the most watched commodities in 2026. Finally, global economic uncertainty amplifies these drivers. Inflation, currency fluctuations, and geopolitical tensions encourage both industrial and investor buying. Silver's volatility, combined with these macro pressures, ensures 2026 remains a pivotal year. The market is signaling traders and investors to remain vigilant for both opportunities and risks in the silver squeeze scenario. Gold continues to shine as a safe haven asset in 2026. Even as silver experiences extreme volatility, gold's trend is more stable, driven by macroeconomic uncertainty and central bank buying. Investors seeking refuge from inflation, currency devaluation, and geopolitical tensions are turning to gold as a long-term hedge. This makes gold a cornerstone of diversified portfolios during turbulent periods. Central banks are actively increasing gold holdings. Countries like India, China, and Russia are adding to their reserves to hedge against market volatility. These purchases reduce available supply for investors and support upward price momentum. Gold's market update in 2026 shows a clear pattern. As uncertainty rises, demand follows. This trend underscores gold's role as a global safe haven asset. Investment demand from ETFs and institutional buyers is also rising. Gold-backed ETFs are attracting billions as investors shift from riskier assets. Even when silver prices spike, gold maintains steady gains because it reacts differently to market sentiment. This divergence highlights gold's stability relative to silver's high volatility and underlines its strategic importance in wealth preservation. Forecasts suggest gold may continue upward through 2026. Analysts predict strong support levels and potential new highs as safe haven demand persists. Unlike silver, which can experience rapid squeezes, gold's growth is steadier but no less significant. For investors, this makes gold a crucial part of portfolio strategy while monitoring silver's high-risk opportunities. Analysts are projecting exciting yet volatile price targets for silver and gold in 2026. Silver's shortage-driven market could trigger breakout levels above $120 per ounce. If the squeeze intensifies, technical analysts highlight key resistance and support zones that traders are watching closely. High retail and institutional demand make price spikes increasingly likely, though the risk of sharp pullbacks remains significant. Gold forecasts remain strong but more stable. Analysts expect gold to hold support near $2,050, $2,100 per ounce, with potential upside if geopolitical or economic uncertainty rises. While silver reacts sharply to short-term movements, gold's trajectory is steadier, offering investors safer growth. Strategic accumulation during dips is advised by many market experts. Precious metals forecasts are also influenced by macro factors. Inflation expectations, interest rate decisions, and central bank interventions can quickly alter projections. For silver, tight supply and industrial consumption remain critical drivers, while gold benefits more from safe haven buying. Understanding these variables helps investors position strategically in 2026. In short, 2026 could be a defining year for both metals. Silver may experience sudden spikes and squeezes, while gold steadily rises with safe haven flows. Investors need to monitor both technical and fundamental indicators closely to maximize gains and reduce exposure to extreme volatility. Silver and gold investments carry unique risks in 2026. Silver, with its extreme volatility, can swing sharply in short periods, creating opportunities but also heavy losses. Traders using leverage or margin positions must be cautious, as sudden price reversals can trigger forced liquidations and significant losses. Understanding silver's dual role as industrial metal and investment asset is key to managing risk. Gold is relatively safer, but not risk-free. Currency fluctuations, interest rate changes, and geopolitical events can still cause sudden price adjustments. Safe haven demand may stabilize prices, but unexpected macro events can produce temporary drops. Traders and investors should maintain risk management strategies, even in gold positions. Margin requirements for futures contracts have increased due to volatility, particularly for silver. These adjustments reduce leverage but increase cash requirements, making trading more capital-intensive. High volatility combined with low liquidity periods can lead to dramatic price swings, creating both opportunities and hazards. Finally, speculation and hype can distort market perception. Social media forums may exaggerate potential squeezes or breakout levels. Traders should rely on verified market data, physical inventory levels, and technical analysis rather than rumors, ensuring informed decisions in the 2026 silver and gold markets. The silver squeeze narrative in 2026 has sparked debate. Some traders argue it's real, pointing to shrinking physical inventories on COMEX and surging retail demand. Data shows registered silver stocks have declined sharply, indicating structural shortages. When demand outpaces available metal, prices can spike rapidly, which is the essence of a squeeze scenario. Critics claim that paper silver markets and derivative positions exaggerate the story. Futures and ETFs allow investors to speculate without taking physical delivery, which can distort market signals. While the hype may overstate the immediacy of a crisis, underlying supply pressures remain real. Understanding the distinction between paper and physical silver is crucial for evaluating risk and opportunity. Regardless of opinion, the market is reacting to squeeze expectations. Short sellers are cautious, and retail investors continue to buy, pushing volatility higher. Price swings in 2026 demonstrate how market psychology interacts with real supply-demand imbalances, creating conditions where a squeeze could happen at any moment. For investors, the key takeaway is clarity. Don't chase hype blindly. Monitor physical silver availability, futures positions, and industrial demand. These indicators help distinguish real market signals from exaggerated narratives. In 2026, separating data-driven analysis from social media speculation is more critical than ever. Silver and gold in 2026 present distinct strategies. Silver's volatility can yield large gains, but carries higher risk. Investors need to balance exposure and understand that prices can swing dramatically in hours. Short-term traders may profit from these moves, but long-term holders should carefully plan entry and exit points. Gold offers more stability and a hedge against macro uncertainty. Safe haven demand, central bank accumulation, and inflation protection make gold an anchor for portfolios. Investors seeking predictable returns often prefer gold, while silver is approached for speculative opportunities and industrial exposure. Diversification remains key. Combining gold and silver investments can reduce risk and capture upside potential. Monitoring price trends, supply-demand metrics, and macro indicators is essential for effective portfolio management in 2026. Both metals require active awareness of market dynamics, particularly during periods of extreme volatility. Investors should also stay informed about regulatory changes, trading rules, and margin requirements. Sudden shifts in policy or market conditions can influence liquidity and leverage. A disciplined approach combining research with risk management will maximize gains and minimize losses in the 2026 silver squeeze and gold market environment. For silver in 2026, watch psychological levels around $100, $120 per ounce. Breakouts above these zones could trigger rapid buying, especially if inventory shortages continue. Traders track technical indicators like moving averages and resistance lines to anticipate squeezes and plan entry or exit points. Gold support levels are equally critical. Analysts recommend monitoring the $2,050, $2,100 per ounce range for buying opportunities and upward momentum indicators. Price trends combined with central bank activity and safe haven flows determine whether gold maintains a steady climb or experiences temporary dips. Technical setups and trend lines matter for both metals. Traders watch for breakouts, consolidation patterns, and volume spikes to signal potential rapid movements. Silver's volatility means key levels may be breached quickly, while gold's stability allows for more measured decisions. Tracking these levels helps investors avoid surprise losses and capture potential gains. Finally, market participants should watch global macro indicators. Inflation reports, currency fluctuations, and geopolitical news can trigger sudden reactions in both silver and gold markets. Staying alert to both technical and fundamental factors ensures that investors are prepared for high-impact events in 2026. 2026 is shaping up as a pivotal year for precious metals. The silver squeeze scenario highlights extreme volatility, supply pressures, and retail speculation, while gold remains a stable safe haven. Both metals present unique opportunities and risks that require careful analysis and market awareness. Silver's sharp swings are a reminder of the importance of understanding supply-demand dynamics and market psychology. Retail and institutional behaviors amplify volatility, creating both rapid gains and sudden losses. Traders must remain disciplined, focusing on key indicators and verified data rather than hype. Gold continues to reinforce its role as a hedge against uncertainty. With central banks buying and global demand rising, it offers a safer growth path in volatile times. Portfolio strategies in 2026 should balance silver's speculative upside with gold's long-term stability to optimize returns and minimize risk. In summary, the 2026 Silver Squeeze and Gold Market Update offer critical insights for investors and traders. By monitoring key levels, macroeconomic data, and physical inventories, participants can navigate volatility while capturing opportunities. Disciplined analysis and awareness of both metals' unique drivers are the keys to success in the current market environment.